Why trading small feels wrong. That's the first thing we need to address. Because if you've been in the market long enough, trading small feels like you're wasting time. It feels like you're not taking this seriously. It feels like you're admitting you're not ready. And most traders don't fail because they don't know this truth. They fail because they can't emotionally accept it. They don't want survival. They want validation. They want to feel like a trader, not build the behaviors of one. So they size up before they've earned it, and the market punishes them for that impatience. Quietly, repeatedly, eventually, permanently. Here's the uncomfortable truth. Most traders don't lose money because they trade badly. They lose money because they don't survive long enough for skill to compound. They treat trading like a performance sport, not a survival game. They optimize for what looks impressive instead of what actually works. And the market doesn't reward confidence. It rewards durability. If you strip trading down to its most brutal reality, it's not about making money. It's about staying solvent long enough to develop consistency. Everything else comes after that. But that idea doesn't sell well, so most traders never internalize it. They think bigger size equals faster progress. They think pressure forces growth. They think discomfort is proof they're doing something meaningful. That mindset destroys more accounts than bad strategies ever could, because pressure doesn't build discipline, it reveals its absence. When you trade too big, you don't become more focused, you become more reactive. You don't execute better, you negotiate with your rules. You don't become decisive, you become defensive. And once defense enters your decision-making, your edge is already gone. Trading big turns every trade into a referendum on your self-worth. Every loss feels personal. Every drawdown feels threatening. Every pullback feels like danger. So you interfere. You cut winners early. You hold losers longer. You hesitate on clean setups. You overtrade to make the pain stop. And then you tell yourself the problem is psychology, but the real problem is size. Size dictates behavior. You don't rise to your plan, you fall to what your nervous system can tolerate. Trading small isn't about fear, it's about creating an environment where you can actually behave like a professional. Professionals don't trade to feel something, they trade to execute something. They don't need the trade to matter emotionally, they need it to matter statistically. Small size removes emotional distortion. It allows you to see price instead of projecting meaning onto it. It allows you to follow rules without bargaining. It allows you to take losses without flinching. That's not weakness, that's control. Most traders never experience this because they never allow themselves to. They rush past the survival phase. They want to skip the part where discipline is built quietly and invisibly. They want results before identity, and the market doesn't allow that. Here's something most traders refuse to confront. If your size makes you emotional, your size is wrong. Not because emotion is bad, but because emotion hijacks execution. You can't trade probability while emotionally invested in outcome. Trading small creates emotional neutrality, and neutrality is where consistency lives. This is where most traders get defensive. They say things like, "But trading small won't get me anywhere," or "I need bigger returns to make this worth my time," or "I'll size down later once I'm confident." That's backwards. Confidence is not built by winning big. It's built by executing correctly regardless of outcome. And that only happens when the cost of failure is survivable. You don't learn discipline by risking what you can't afford to lose. You learn discipline by proving to yourself that you can follow rules under no pressure. That's the foundation. Trading small allows you to separate self-worth from P&L. A loss becomes data, not damage. A drawdown becomes feedback, not fear. You stop asking, "How do I make money faster?" and you start asking, "Can I execute this the same way 100 times?" That question changes everything. Because now trading becomes boring, predictable, repetitive, unimpressive, and that's exactly when it starts working. Most traders quit right before this phase because boredom feels like stagnation to an ego that wants stimulation, but boredom is where mastery lives. Every professional trader you admire went through this stage. Quiet months, small returns, unexciting progress. Not because they couldn't trade bigger, but because they understood something most don't. Survival precedes performance. If you can't stay in the game, nothing else matters. And here's the part that really stings. Trading big doesn't accelerate success, it accelerates exposure. It exposes impatience. It exposes poor risk tolerance. It exposes emotional fragility. That's why traders who size up early burn out fast. They experience everything too intensely, too soon. Losses hit harder. Wins distort perception. Drawdowns feel catastrophic, so they never stabilize. They're always reacting to their last result instead of following a process. Trading small slows the feedback loop. It gives you space to observe yourself, to notice patterns in your behavior, to correct mistakes without panic, to build trust in your own execution. And trust is everything. You don't become consistent when your strategy improves. You become consistent when you trust yourself to behave correctly under pressure. Trading small is how that trust is built, not in theory, in practice. Day after day, trade after trade, no hero moments, no emotional spikes, just repetition. This is where identity shifts. You stop trying to prove you're a trader and start acting like one. You stop measuring success by single trades and start measuring it by how clean your execution was. You stop caring about how fast the account grows and you start caring about how stable your behavior is. That's when profitability becomes inevitable, not because you forced it, but because nothing is sabotaging it anymore. The traders who last aren't braver, they're not smarter, they're not more aggressive, they're more patient with reality. They accept that trading is a long-term skill acquisition process, not a shortcut to financial identity. They respect compounding, they respect drawdowns, they respect survival. And because of that, the market eventually respects them back. Trading small doesn't mean thinking small. It means thinking long-term. It means understanding that the goal isn't to win big. The goal is to still be here when others are gone. Because the market doesn't reward intensity, it rewards consistency. And consistency only exists where survival is prioritized. So if trading small feels uncomfortable, that's not a flaw. That discomfort is your ego realizing it's no longer in control. And that's exactly where real traders are built. Quietly, slowly, without applause. That's why trading small is more profitable than trading big. Not immediately, not emotionally, but inevitably.